Hello and welcome to Forex.Academy, your #1 website for Forex and crypto education and analysis. In today's edition, we're going to be looking at how to get an edge using statistical thinking, part 1. Do you know the difference between institutional traders and the average retail trader? Well, there are many obvious differences, including the capital available to them. Still, the most significant factor is that you blindly believe in technical analysis, whereas they use other higher level techniques to stay a step ahead of you. The mathematician is highly paid in the financial markets for a reason. They make a real difference. The marketplace is a battlefield of quant analysis. If quantitative analysis is the equivalent of a smart drone attack, then technical analysis is like fighting with spears and arrows. You may say to yourself, I don't have that software. Of course, professionals use large databases and sophisticated analytical software, machine learning, and so forth. If you're serious about trading, you should consider creating your custom analytical software. The use of high-level languages such as Python in combination with pandas is a terrific statistical package. Still, with patience, dedication, and a spreadsheet, you could collect your own information in Excel, which is also included in a decent statistical package. MetaTrader 4 to Excel. It is possible to automate your data capture from your MetaTrader 4. MetaTrader 4 has a DDE link. It is straightforward to get it done. You simply need to enable the MT4 DDE server and place a simple code in the corresponding Excel sheets. This is shown here. Average trading ranges. Determine trading ranges can be accomplished by using the average true range indicator, the ATR. There is no need to collect data to use it, and it will provide you with basic information to know a lot of things. Using a short-term value such as a 10-period ATR will tell you the Forex pair you intend to trade is experiencing a period of low or high volatility, or if its current range can be considered as normal. This knowledge will show you several interesting facts that may decide if it's worth trading or not. The ATR is the average range traded for the period. Therefore, it tells you the expected movement of the time frame of your chart, so it is at the same time your risk and your potential profit per time frame. It tells you several pieces of information. Your stop-loss pip distance divided by the current ATR will say to you that the average time it will take the market to reach your stop, for example in a 4-hour chart, if the stop-loss is 10 pips away and your STR is 16 pips, you know the average time a bad trade will take to reach your target is 10 divided by 16 times 4 hours, equaling 2.5 hours. Your profit distance divided by your current ATR will tell you the average time it will take your trade to reach your target. Your trading cost, which is the spread plus fee plus slippage, multiplied by the profit to ATR ratio, divided by the ATR and multiplied by 100, will tell you the percentage of the projected profits that are needed to break even. That value will help you decide the best time frame for your needs. If you are aware of the overall cost of the operation, you may realize you're mostly working for your broker and that a better time frame is needed or that the current market ranges are not suitable for trading. Determining turning points and the concept of range stats. Now, if we collect the averages of trading ranges, we can get a lot more exciting insights about the market. What if we could get a real edge over the market, statistically relevant and profitable long term? Going back to our previous video about the normal distribution, we talked about the central limit theorem. This theorem says that the average value of a collection of samples will be normally distributed. If we apply this concept to the collection of ranges, we will get a bell-shaped curve, including its statistical properties. Up and down ranges. If we have our data located, we could compute the average range from the opening of our session to the low of the session. Let's call this piece of data the down range. We can then do the same for the gain data. This is the range from the opening to the high of the session. That will be called the up range. If we store the up range and down range measurements, we can compute the average of the last 30, 50, or even 100 days and its standard deviation. We can then apply some statistical thinking regarding this data. In our previous lesson about the normal distribution statistical properties, we have learned that 68.2% of the data points belonging to a normal distribution are located in the region between the average plus and minus 1 SD. That means that only 31.8% of the data points are beyond that area. And looking to the right side, only 15.9% of the ranges are higher than the average plus 1 SD. On this fact lies our trading edge. Our data collection of up and down ranges tells us how far, on average, the asset moves before turning in the opposite direction. Thus, our technical analysis signals will be much more statistically significant when the up or down typical range has been exceeded by 1 SD. In other words, there is a high likelihood of the currency pair reversing. Taking profits could also be influenced by this type of strategic information, as well as computing the typical range the asset moves after turning in the opposite direction and then applying it to our trading. If you enjoyed the video, then please like and subscribe, and leave a comment down below about anything you would like us to discuss in future, or if you have any questions about this particular video. Have a great day.